Welcome to Retirement Straight Talk with Paul and William, featuring award-winning financial advisor and former host of the Sunday Money Show, News Talk 1010, Paul Baraka, and his associate advisor, William Baraka. Creating and keeping wealth does not need to be complicated. Paul and William will cut through confusing and contradictory financial advice to give you the real facts to help you invest better and enjoy a worry-free retirement. The views and opinions expressed in this video may not necessarily reflect those of IPC Securities Corporation. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.
Hello and welcome everyone to episode 51 of Retirement Straight Talk with Paul and William. And whether you're watching us on YouTube or one of the streaming services, we're here to talk today about the business owner. You know, we spend a lot of time, a number of our clients are business owners, and specifically today, we're going to talk about the family trust. Now, I think the family trust is an overlooked strategy for business owners, but it has the potential to be perhaps the biggest tax-saving strategy a business owner can utilize. So we're here today and have a special guest today. We are featuring Dennis G. Serre. Dennis brings over 30 years of taxation and planning experience to clients and financial advisors across the country. He began his career with CRA, what a great place to work, and is a member of a variety of pension committees, taxation and planning, such as Advocates, KALU, and he remains a leader by researching and providing unique tax alternative to business owners and high net worth individuals. I've been working with Dennis for, I don't know, Dennis, what, 10, 15 years, maybe longer? I don't remember. So we've worked together for quite some time. So thanks for joining us today.
Thank you for having me.
So now I don't know about you, Dennis, but I don't know one business owner who feels they don't pay enough tax. I don't know if you've ever come across one of those. What we see, I think you'd agree, what we see prevalent with business owners is they're often unprepared for their own exit strategy. They're unprepared to make their business more saleable, if it's a saleable business. And they're certainly unprepared for retirement. They often haven't looked at things. For example, should they be incorporated? Should they not be incorporated? Oftentimes, more often than not, they don't have a tax-efficient retirement plan set up. And by the way, I mean, this is something I bring up a lot, Dennis. I mean, our retirement years could be upwards of half our entire adult life. It really, don't you find that a lot of business owners, they kind of leave their retirement up? Their retirement strategy is hope. And hope is not much of a strategy. So again, we find business owners, oftentimes they're putting money into their RSP just for the tax deduction. They're not really looking at it as a retirement strategy. And oftentimes don't you find, Dennis, they're depending on their business for their entire retirement strategy. And then there's some big risks that come along with that, aren't there?
Definitely.
So for example, you could say, oh, I have my business now. It's the best place to put my money. I'm earning 15% or 20% return on it, whatever the number is. It's worth $4 million, whatever. Until it's not. Until technology changes. And maybe that business that was worth $4 million, maybe you're not competitive anymore. Maybe there's new competitors that come in the market that can do a better and cheaper job than you do. And maybe that $4 million business that you were dependent to fund your retirement, maybe it's worth $1 million. Or maybe there's no buyers at all for it. Now, can you imagine, Dennis, spending decades building a business, working hard, working evenings, weekends, the whole shebang. And then just when you're ready to enjoy it, something happens like what we just discussed, and boom, what do you do? So again, what we find is one of the most important things people or business owners should do is really have a multi-sourced retirement plan. Just to reduce, it's common sense. I mean, you don't want to depend on any one thing. So other potential income sources could be your investment portfolio, RSPs, IPPs, individual pension plans. By the way, that's another thing, Dennis. A lot of business owners haven't looked at whether they should have an RSP or an individual pension plans. Individual pension plans are great. We've worked together with them a lot.
Yep.
For the right business owner, they're great. Again, you need to get proper advice to determine whether it makes sense for you. The business owner could depend on a portfolio owned in their corporation, a holdco, rental income from the sale of their business. So why don't we move on? We're here today to talk about this one major strategy, a family trust. And before we do it, disclaimer. Business owners, you're listening, do not make decisions about whether you should implement any strategies without getting proper professional advice from your advisor who is well experienced in business owner issues, from consultants like Dennis, your accountant, your lawyer, and so forth. You really need proper financial health before you make any decision. Otherwise, you're putting yourself at big risk. Dennis, now the family trust, we've worked together on this for a number of our clients. What is a family trust? Let's start at the beginning here.
Well, family trust, it's a legal arrangement that it's put in place that the settler transfer assets to the trustees. So you have trustees that manage the plan, and that's for the benefits of the beneficiaries, which are usually the family members.
Now, the family trust, excuse me. So when you talk beneficial ownership, we're talking about ownership in our situation of the business, right? For the most part.
Yes. Yeah. In this situation, we're going to focus strictly a discretionary trust, really on the tie with corporations for this discussion today. So really, it's a legal arrangement that a settler settled that transfer the power to the trustees, which could be yourself, your spouse, if you're the business owner, for the benefits of your children. And you can either do capital distributions or you can do income distribution, depending on what the main goals are.
Now, just to clarify, a settler is the person who owns the business, who puts it into the family trust, right? That's the settler.
Usually, yes. Yeah.
Okay. All right. So why don't we talk about why business owners would want to consider a family trust? Why don't we talk about some of the benefits? There's a number of them we talked about previously. Maybe we'll go through them one by one. First one, I think, privacy. Let's talk about privacy.
Well, privacy is really, the trust, it's a legal arrangement that it really keeps everything about the beneficiaries and everything is kept confidential. It's a legal arrangement. So it's not public knowledge. It's not disclosed. It's very kept confidential.
Okay. And some people, that might be very important if you're dealing with significant assets. You don't want the general public to know how much and where and who owns what. I could see for a lot of people that would be important. Now, the next item is something that I find a lot of people talk about, and perhaps too much, and that's probate. People want to avoid probate fees, and probate fees are 1.5% in Ontario, right?
Correct.
So, go on.
Well, probate fees, it's really, so the assets have been transferred without being subject to probate fees. So they bypass the probate fees inside of a family trust. So they're not subject to probate fees.
Yeah. And that's worthwhile. You're saving 1.5%. Sometimes I find people, Dennis, when you're right, they spend too much time focused on probate fees. Probate 1.5%. If you have an investment portfolio or real estate, your value of your investment can go up or down 1% in one day. So that's great, but I certainly wouldn't do a family trust just to eliminate or really postponing probate fees. Now, next benefit that we talked about, something that could be life-saving in certain circumstances, and that's liability limitations. Let's talk about that, Dennis. Let's define it first, what that means.
Well, what that means is because the trust is a legal agreement, it's protected from the creditors and legal claims. So it's its own entities. So it's fully protected from that standpoint.
So there's no way. So if a business owner transfers ownership of the business to the family trust, you're saying it's pretty rock clad that if the business owner is sued for whatever reason, they can't attack the family trust. They can't attack the ownership. Is that right?
That is 100% correct.
Okay, fantastic. Let's talk. You mentioned before about distributions from the family trust. Let's define, what does that mean? We talked about capital. You talked about income. Let's determine. What. Let's define what each one of those is first. Then we'll talk about it further.
Okay, so income distribution is basically if your trust is tied to your operating company where you earn your active income, and you do a distribution to what we call an intercorporate dividend to your family trust, and you distribute income to your beneficiaries that qualify, that follow what we call the TOSI rules. I'm sure you're going to ask me more about that in a minute.
I'm sorry, the 2C rules, is that what you said?
Yes. TOSI rules.
All right.
Yeah.
So, okay.
Tax on split income. And then the other portion would be capital distribution. So let's just say that you sell an asset and that is owned by the trust. You can distribute the proceed of that asset to a beneficiary of the trust. Because it's a discretionary trust, you have the full flexibility who you want to distribute it to.
Okay. So now, are there any limitations at all to that? Any limitations at all there, Dennis?
You would have to be a beneficiary from the get-go if you're distributing, say, proceed from the sale of the business, right? You can't just add beneficiary a year before you sell your business and just say, the business has been there for 20 years and now let's distribute it to all these grandchildren that had nothing to do with the business or had nothing to do tied with the family from way back then. So there are some attribution rules you have to be careful, definitely.
Let's go back to income. So you talked about, let's say, the operating company, you own a business, you put the ownership of the business, the family trust, the business makes a profit, you want to distribute those. Let's talk about some of the limitations on distributing just regular operating profits to the beneficiaries. I think there's some age limitations. Is that not correct?
There is some age limitation. But the main key thing is you have to be what it's called, tax on split income. That's what 2C rules stand for. They came into effect a few years ago from the federal government. And what it did, it stopped from distributing dividends to beneficiary, which would have been children that maybe not involved into the business or anything, and just pay them straight dividend for schooling, for helping them with their expenses, where today it's basically they want you to be working at least 20 hours a week in order to qualify for the receiving dividend. Now, totally separate from the business owner. Let's say that you got mom and dad who have been the main shareholder for many years and they did a rollover to the family trust. They can still take the income out without having to worry about the TOSI rules, because they were the main funders.
So really, you need to work in the business, at least on a part-time basis, on a regular basis, to be able to get distributions of income. Is that correct?
Correct. Okay. And then that's where the 25-year rules apply.
Okay, the 25-year-old. Is that correct?
Yeah. Yes.
So let's talk about that. So if you're a beneficiary of the trust and you're under 25, but you're an adult, or you're a beneficiary and you're over 25 and you're an adult, let's clarify what the difference is there.
Well, so if you're a full-time employee, let's just say that you're a full-time employee into the business, you're a beneficiary of the trust, you're 21 years old, you will be able to receive some dividends. But if you're just part-time, not working 20 hours a week and everything, you will not be able to receive the distribution. That's where the 25-year-old will be able to receive it if they work 20 hours a week. So it's something that you have to be careful. There's new schedule that the accountant have to prepare to make sure that whoever is receiving the distribution meets the requirement from a CRA
Okay.
standpoint.
And the big advantage there, obviously, is really income splitting. If someone's legitimately working in the business over 25, well, they're going to probably collect a dividend and probably pay potentially a lot less tax on that income than, ma and pa or the owner, who's probably in a higher tax bracket, right? Really, it's an income splitting tool. Okay. So capital distributions, you talked about that. Something sold. I don't know. Maybe the business owns a piece of property and they sell it. Let's talk about that. How that works in the distributions.
So you sell a piece of property that the business own, and the gain flows through the company, through the trust. You can distribute the proceed to any beneficiary. The TOSI rules is not applicable. TOSI does not apply
Okay.
on capital distribution. So only on income.
Good. All right. Now, one of the other benefits we talked about was tax deferral using the family trust. Why don't we, let's talk about that a little bit. How does that work?
The tax deferral is really multi-generational, where that you have, depending of your structure. So let's just say that you have the family trust owning the common shares into your operating company. In this example that you're referring to, and unfortunately, mom and dad pass away, we still have a shareholder into the corporation, which is called a family trust. Mm-hmm. That could be the children, it could be adult children by the time that mom and dad pass, unless something unfortunate happened to the parents' earlier age. So the trust could continue on owning the ownership into the corporation without having to do a full wind up and a full taxation.
Okay,
so really deferring it to the next generation.
Okay, deferring the tax on any realized capital gain in the business, right?
Yep.
Okay. Next one, and this is the benefit that I like most. Again, I meet so many business owners who are missing this. They have a business worth several $1 million, and they're the only owner. Well, why isn't your spouse on board? What about your adult children? It's not done. The multiplying the lifetime capital gains exemption. I think the lifetime capital gains exemption is over $1 million per person now, isn't it, Dennis?
It's very close to it. It's currently at $971,000, and it's going to be, as you said, very soon $1 million plus. So
okay. So how does this work? Multiplying, that's a big exemption. How do you use a family trust to multiply that capital gains exemption?
If you have established a family trust that you have that owns the common shares, and you sell the common shares, say for $5 million, and that amount was paid to the trust, that $5 million, instead of going to one individual, as you mentioned, now you have maybe 5 individual, meaning the owner, the husband, and then you have the wife and maybe the children that can use all the lifetime capital gain exemption on selling the share of the business. And I mean, that's a tax saving of approximately $238,000 per $1 million. That's a big tax saving.
Dennis, that's what I find a lot of course, and there's reasons. A lot of business owners aren't focused on this, and I can understand it because, quite honest, they're busy running their business. They're busy putting out fires and generating new business. They often miss the big stuff like this. So that to me is probably one of the best benefits of the family trust, multiplying that personal lifetime capital gains exemption. Now, there's also something called an estate freeze.
Yes.
That I think you can utilize in the family trust. You don't necessarily have to have a family trust to utilize this, though, do you?
No, you can do an estate freeze. An estate freeze is really you value your business, you freeze your current shares that you have. Usually it's your common share because that's the growth. And then from there, you draw a line in the sand to say the business is worth X dollars today. Going forward, you allocate a new class of share for the previous value. So it's frozen, as you said, in the estate freeze. And then the future value, if you use a family trust, which or you can use a holding company if you wish to do so. And then what happened there, it's the the new comments would be allocated to your holdco or your family trust, depending what structure you go with. But there's some complication that people sometimes don't understand. It's just having a holdco on top of an opco without having a trust.
Okay, so that having the family trust makes it a more efficient. Is that a fair comment? Makes it a more efficient arrangement?
100%.
Okay, all right. So, is there any other benefits? I think we hit most of them, Dennis. Did we miss any of the benefits there of potential?
Yeah, one of the benefits, what people don't truly understand is a lot of people have an operating company and they'll say, oh, I'm just going to create a holding company. Well, what happened with the holding company? It's either the main shareholder of the operating company that now owns the shares of the holdco, and the holdco owns the share of the operating company. But that's great to move money from one company to the other company to try to limit the amount of cash that you have. But what's the exit plan? This is the part where
Oh boy.
As you said, where's the exit plan? You're just ballooning a holding company with so much cash, and then they're like, oh, can I use a capital gain exemption? Can I use this? And suddenly it's like, whoops, doesn't qualify. So
now, why wouldn't? By the that's really lately I've come across a line which I think is great for any financial planning, and it goes like this: it's plan now or pay later. And I think that is perfectly accurate in this situation. People put off doing their planning for whatever it is, a family trust or an exit strategy, until it's too late. Oh, I should have done this 10 years ago. Boy, have I heard that a lot of times. So
we all did.
Yeah. So if you were saying, what would a business owner that would be a poster child for a family trust and a reorganization, what would that poster child business owner look like, Dennis?
No, it's really the part on you're talking cost or structure. You're looking like from the planning. What the area do you want me to go down?
Just big picture. You're a business owner in general. I would think for one, is it a saleable business? If you're just working and the business is you, it's not really a saleable business. This really doesn't apply, probably. Is that a fair statement?
Definitely.
Okay.
Definitely.
So you have to have something that's saleable to have it worthwhile, and probably at a reasonable size. If you're just a small business, you have a corporation, you're making an income, but you're paying out most of or almost all of your income in salary to yourself, maybe your spouse. Again, maybe not. It might not be worthwhile. Does that make sense, Dennis?
It does. We have a process, as you know, is really, we call it an analysis roadmap. Is every situation is different. Is what are they trying to accomplish? What's the goal, the objective? And what we do is we do what we call a file review, is look at the current situation, is what do you currently have? What are you trying to do? And it's a structure, right?
Okay.
That's really where you start. And then from there, you can engage the client and everything and say, well, let me create you the right roadmap to what you're trying to do. This is how you should go about it. And here's the benefits and the advantage of going through this process. As you said, could have been someone trying to sell the business, could have been a farm trying to pass to the children. It could be so many different type of aspect. Could be, I want to have my two key employer to become ownership into the business.
That's another interesting cool. And it really emphasizes the need for proper advice here to determine, does this make sense for you? If it does, what are the benefits? Does it match what you want to see happen down the road? Now, there's always, like any strategies, there's always some disadvantages of working in this one. You have, for example, the costs. Let's talk about the upfront costs, ongoing costs. What are we talking about here, Dennis?
Well, it all depends. It's like, what are you doing? Are you doing an estate freeze? Are you just trying to establish a trust? So your costs, you're going to be anywhere from 15,000 to 30,000, depending, like, are we talking one business? Are we talking multiple businesses? Are we doing an estate freeze, meaning a Section 86? Are we doing another section of rolling other shares, Section 85? Are we doing trying to strip some of the earnings up to the whole co and meet safe income? So, we can go from a small range of very little, as you said, small business owner to a very profitable business owner with trap return earnings in the operating company. So the range varies.
Okay, it depends. All right, that makes sense. There's something called the 21-year rule for trust. Why don't we explain what exactly that means?
What it means is that by the time year 21 of the trust comes around, if you have not done any planning, the trust would have to settle at that point, meaning to wind up. So any income, any ownership that it has, it would have to realize it. So
You mean realize the unrealized gain, capital gain?
Correct. Correct.
Okay.
Yes. So that's why with doing proper planning, you're able to, by the year 19, 20 years, to avoid that distribution. So you just do a capital distribution to a key beneficiary to roll the shares at the ACB into a holding company attached to another trust that you restart the 21-year rule. So there's ways around it without creating a taxation event.
As usual, it all depends on proper planning and getting great advice. What about taxation in the trust? I mean, in a trust in itself, income into the trust is not very tax efficient, right? It's taxed at the highest marginal tax bracket. And you get around that by distributing the income every year to the beneficiaries. So it's taxed in their potentially lower tax bracket. Did I get that correct?
That is, you did.
Okay. All right. Last thing we want to talk about here. Can the trust be unwound? You set this up, things change. I don't know if the trust is appropriate anymore. Can you unwind the trust?
The answer is yes. But again, proper planning, proper understanding of the trust documentation and what are the impact. So yes, the trust can be unwind. Definitely.
Okay. Well, I think we've covered a lot of ground here, Dennis. Thank you so much. We've talked about, the problems business owners come across through lack of planning and because they're busy running their business, totally understandable. The potential benefits of the family trust and, some of the areas of the family trust that may be not the best thing. But again, proper planning is key. So with that being said, I want to thank you, Dennis, for joining us today. That was fantastic. Great information. Now, if anyone wants to get in contact with you, how do they do that?
Well, they can contact the office or go on our website. So Serre Financial or www.serre.ca. So SERRE.ca, or call our office at 1-866-927-0111. Or they can shoot me an email or they can contact you. So my email is dserre@serre.ca. So my first initial, my last name at the last name.ca.
Okay, that's pretty easy. Well, again, Dennis, thank you so much. We'll have you on again. There's so many things we can talk about for business owners. Let's try and do this again, have some more fun down the road. In the meantime, hey, and remember our next podcast, boy, this is going to be interesting. So many people say to me, oh, it's an election year in the US. Is that good? Is that bad? We're going to talk about the election years. Does it make any difference? How should you deal with your portfolio? If you should make any changes at all. That's what we're going to talk about in the next Retirement Straight Talk with Paul and William a couple of weeks down the road. In the meantime, if you'd like to get a hold of myself, obviously just info@westendwealth.com. I am on LinkedIn. William, my cohort in these, normally on every episode, is available on X and LinkedIn. And I think that's it for today. So thanks for joining us again. We'll see you in a couple of weeks. Take care. And thank you again, Dennis.
Thank you for having me.
This podcast was brought to you by West End Wealth Planning, an award-winning wealth planning practice catering to small and medium-sized business owners and to those looking to create a worry-free retirement for themselves and their families. To learn more, go to westendwealth.com. Don't forget to rate this podcast and subscribe to Retirement Straight Talk with Paul and William by going to Apple Podcasts, Spotify, or wherever you find your podcasts.